In the meantime, we have Mayuresh Joshi, Fund Manager, Angel Broking, joining in with his views. Mayuresh, the opening question is really about what you're advising clients to do right now with a 3.5% fall on the benchmark indices for this week and a near 6 to 7% fall for the broader markets. Is it, are you asking clients to book profits?
No, it's not about booking profits, Tanveer. I think it's about keeping the faith in the markets. And where investors were probably looking at the markets at 10,000 odd levels and being very, very optimistic, all the factors that have probably played on the downside for the markets, the SEBI order that came through, the geopolitical tensions that are brewing at this point of time, the margin calls that have probably got triggered at the broker's end, and the slew of results that have come today which have largely disappointed the street and the analysts. I think all these factors are playing out on the markets, but a large part of the consensus still believe that earnings recovery should start happening in the second half. The liquidity is still strong. So I'm not perceiving a sharp correction in the markets even from the current levels. I think any further depreciation or deacceleration into the markets actually become good buying opportunity in qualitative stocks. I think you can actually park 15-20% of any of the money that you probably kept on the sidelines in qualitative stocks on any sharp correction that you further see into the markets.
Okay, so give me that one name, maybe two, where you're happy to allocate 5, 10, even 15% of your portfolio.
So again, out of the large cap names, Nikunj, ICICI Bank is something that I've been liking over a period of time. Yes, the banks are clearly struggling on the corporate side of the book, with slippages still staying on the elevated levels, and that has clearly eaten down into their margins, credit cost remaining high. But again, I think a large element in what my analysis shows over the next few years, FY18, the next 2 quarters, a large cleaning up will probably start happening onto their books, and that's already happened in the Q1 that has gone by. So again, I think ICICI Bank is something that will be very, very comfortable on any decline to probably look at from the large cap names. And from the mid cap universe, my own sense is that a stock like Carborundum Universal, I've been liking this stock for a period of time. The abrasive element of the business has clearly struggled because of GST implementation, but you look at the unorganized pie in the markets that it caters to, I think there is a huge scope in terms of earnings upgrade over the next few years. The management is very, very confident of posting revenues in excess of 15-20% consistently over the next few years. They've actually shut down a lot of their unprofitable international operations, and as both these synergies start moving together in terms of their consolidated top line, the margin improvement is going to be very, very significant. Again, from a balance sheet perspective, I think the balance sheet is extremely strong, minimal debt equity on its book, and the return ratios are poised for exponential growth, in my opinion, over the next 2 to 3 years. So if somebody has that horizon, I think a lot of money can be made in both these stocks over that time frame.
Okay. 10 minutes to go before we wrap up trade, 320. Let's get an idea from...
Irrespective of the price point, whenever you bought Sun Pharma in the last 2 years, you've actually lost money.
Oh, absolutely, Nikunj. And again, I think all the stocks that you're probably referring to, I think there has been something related to either drug launches or delay in drug launches or FDA issues that have been plaguing their balance sheet. Couple that up with the pricing pressure, which is a known fact for the markets at this point of time. So a lot of management commentaries are hovering around the fact that this fiscal is going to be a washout in terms of both muted top line growth, margin pressures being reflected because of the remedial costs, R&D spends also weighing down on the operating side of the business. So largely, again, I think the temptation is there to specifically look at pharma stocks, but the time horizon has to be more than 2 years at the time juncture that we are sitting on the markets. Next 2 to 3 quarters are going to be extremely soft for a whole host of pharma companies. But again, I think selectively stocks like Aurobindo have reported a reasonable set of numbers. Their injectables business is expected to grow at a very decent clip. The margin on those business is pretty large again, and the antiretroviral business that we are talking about is a $70 billion business that is expected to go off patent over the next few years. So I think I'll be tempted to look at selective stocks. Stocks like Lupin, Sun Pharma have corrected significantly from where they were 3 months, 4 months back. So from a valuation perspective, does that make sense? It does make sense. But incrementally, I think the weightages on these stocks probably should be a little bit lower. But yes, I think I will be tempted if one really has a time horizon of 2 to 3 years, because the pipeline is strong and the earnings momentum can actually pick up over the next 2 to 3 years.
Okay. Mayuresh, thanks for that perspective. 97